Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to income statement accounts, allocating income statement accounts in the order in which they would be found in an income statement. Get ready, because it's time to take a stance with corporate finance. Here we are in OneNote. If you would like to follow along, and you're not required to follow along, but if you have access and would like to do so, we are in the tab 215 Income Statement Account Order under the Practice Problems section. Closing this back up, we're going to have our information up top. What we're going to have is basically all of our income statement accounts. We're going to have just a list of income statement accounts. They're scrambled. We're going to put them in the order of a standard type of income statement, the goal here being that we start to just get to understand what an income statement looks like. If you just look at an income statement, they can often be quite long and intimidating looking. And that's because your eyes just roll over. There's nowhere to really focus if you don't know what you're looking at or if you're not used to looking at them. So we're going to build these things from piece by piece so that we get more familiar with the components of the income statement. And then when we work with an income statement, they're not going to be intimidating looking, right? We know what to expect, we know what the subtotals mean, we know how they're constructed, and we know where to go for the information that we want from them. So what we're going to have then is going to be our list of accounts. These are going to be standard kind of income statement accounts. They're scrambled. We're going to be pulling those income statement accounts and just putting together in order by name without the number, just memorizing what the names mean for these accounts, what order the income statement will be in. So here's a smaller kind of breakout of this information. Here's our list of accounts. We're going to go down here to the income statement, pull this information from the items up top down on the income statement. So I might not go back up here each time. If you work through the OneNote, you can go back up and pick these up each time. I might just basically go through this so you can kind of memorize and think about the components of the income statement by just memory, really. So when you think about the income statement, the first thing that's going to come to mind, of course, will be the revenue. So remember, the income statement is going to be that timing statement. It's going to be the statement that you're thinking about how we did over time, performance measure. So you're always thinking revenue. That's what, from a financial perspective, the goal of the company is. That's why the company has what it has, right? That's why you have the company. The company is set up from a financial standpoint. Again, we're obviously, whatever business we're in, we're saving the world and we're doing great things and everything. And our mission statement is to make mankind and peace on earth. But the revenue is a reflection of how good we're doing at that particular goal, you know. And so the revenue is going to be, from a financial statement, the line. That's why we have assets. We have assets to help us generate revenues in the future. We have liabilities to help us finance the revenue generation we hope to have. We have expenses in order to help us generate revenue. The whole thing is geared towards revenue. That's our performance statement. Just like a runner is trying to take time off their how long it takes them to run a mile or something. A weightlifter is trying to put more weight on the bar. That's the point. So we're trying to bring up the revenue. We would like to do so, of course, by doing it more efficiently, lowering expenses at the same point in time, net income going up. But revenue is going to be, you know, kind of our goal. Generation of revenue is how we have things. So that's going to be our top line, our performance measure. Remember that you need to have a time frame to do that. When we measure revenue, we're measuring how we're doing over time. So we're talking year ended, meaning how much revenue did we make in 12 months? Month ended, how much revenue did we make in 1 month time period? We're talking performance measures here. Okay, so that's going to be the top line. Remember that revenue could be called sales. It could be called income. It could be called fees earned if it's a service company. So we could have different names, but the account type is the same. It's revenue. Then we have the cost of goods sold. Now that's going to be an account that's going to be used if we sell inventory, as we have seen in the past. Cost of goods sold represents an expense, but it's a special expense. One, because it's going to be the largest expense typically, and two, because it's an expense where we don't actually expend money at that time, unlike the phone expense or the utilities expense. The cost of goods sold usually represents inventory we have on the books for something we paid for, spent money for in the past, put it on the books as an asset. We are now consuming an asset, not cash, but inventory, in order to generate revenue. Then we typically have the gross profit. That's going to be a subcategory along the way. Revenue minus cost of goods sold is going to give us that gross profit. So that's going to be a pit stop along the way as we go towards the bottom line, which is going to be net income or income after taxes. Then we have the selling and admin expenses. The selling and admin expenses are going to represent the other major groups. So typically you're not going to have just selling expenses, right? You might have one line item called just selling expenses, but you might have another subcategory of selling expenses. And then within selling expenses, you might have things like commission expenses, the expenses on the sales store. So if you think about selling things, like if you sell guitars or something, the shop that you sell the guitars in is going to be all that stuff, is everything related to the maintenance of the shop could be included in the selling expenses. The admin expenses, again, might be another subcategory. You might have admin and then all the expenses related to admin, which includes all the administrative kind of costs. And in that, you would think about the corporate office, everything in the corporate office, corporate management costs, and all that kind of stuff, everything that's related to the corporate office, you can think of as might be in the admin type of costs. Then we're going to have the depreciation. Again, we're breaking that kind of out, the depreciation expense here, because we're going to kind of focus in on it later when we think about the cash flow statement and whatnot. And it's a kind of a special expense that really, it emphasizes the accrual basis. It's one of those areas where we can really emphasize an accrual basis. Because remember, many types of things on the expense side, you can think of like a telephone expense, utilities expense, which could fall in the selling and admin categories here. We often pay cash for those types of things. The depreciation expense represents something on an accrual basis because it represents something that we purchased in the past, something large, something that's a depreciable asset, such as building or such as equipment, which is going to benefit multiple periods into the future. Therefore, when we purchased it, even if purchased for cash, we did not expense it at the point in time of purchase, but rather put it on the books as an asset, and then we allocated the cost to the periods we think are going to benefit as best we can, so that we can have better comparison of our performance from period to period. Now again, you might say, well, that kind of distorts the cash flow. That distorts how much money I have. I'm most concerned with my cash flow. We do have a cash flow statement. That's okay. We have a cash flow statement. We will be concentrating in on cash and thinking about cash flow, but we don't want the cash flow to distort the performance. So we want both. We want the best of both worlds. We want to have performance, be able to measure this year to next year, not have some huge purchase throw off the measurement performance-wise of how we did this year to next year, since the thing we purchased is benefiting both this year and next year, and we want to know the cash flow that was spent on that. Therefore, income statement showing performance, trying to measure evenly, trying to be fair from period to period how we did. And again, if you have major cash expenditures or you don't have major cash expenditures, a cash basis, in other words, can easily be distorted by distorting the cash flow, by distorting the timing that cash is either paid or received. Therefore, an accrual basis is much better for performance measure. The depreciation expense is a good example of that. And then the cash flow statement will help us out with the cash needs to make sure that we're meeting our cash flow needs. So then we're going to have the operating profit. So the operating profit would be calculated as the last pit stop we had before, which is gross profit, minus all the selling and admin, minus the depreciation expense, gives us our operating profit. When you're thinking about operating profit, it's a pit stop along the way. We're not to the bottom line yet. We're not to net income. And remember, you could think of the income statement in its essence. The most simple income statement would just be revenue minus expenses. You know, two things there, revenue minus expenses. But we want to have more detail. We want these pit stops along the way to get to the net income down below. The operating profit is another significant pit stop. Why? Because it represents the expenses that are part of our normal operations. Meaning, if we didn't have anything funny happening, then this would be our normal expenses. You can expect these expenses to be similar. If you want to measure our performance on what we actually do, the core of our operations, then you should be measuring this top half of the income statement, because these are things that we have control over, or these are things that we are responsible for normal operations. Things under this, say we're going to put like interest expense under this here, right? I think interest expense. are things that we do have an expense and we have a responsibility for it. We might have an expense later, but the expense is a result of financing. It's not a result of our normal operations. If it wasn't for the fact that we have a financing, we wouldn't have interest expense. If we didn't need to take out a loan in order to finance the operation, we wouldn't have the interest expense. So we're considering then the interest expense being below that. In other words, like if you were talking to a bank or if you were talking to get a loan, you could say this is my operating profit. Or if you're talking to an investor who might be able to pay off the loan if they wanted to buy the company or something, you'd say, hey, this is our normal operations, not including this thing that's not really part of the normal operations. It's only there due to financing, due to the loan we had to take out. Remember that interest is basically rent on the loan. We borrowed money, just like borrowing an apartment, living in an apartment or living in an office building or working in an office building. We're renting the space. We're renting the purchasing power of money. Therefore, we have to pay rent on that purchasing power that we're using, consuming at this point. That's called interest expense. It might as well be called, money rent, right? Purchasing power rent is a similar, same thing. Earnings before taxes. So now we have the last pit stop, operating profit minus anything else that's not in the normal operations that's going to be an expense. That gives us earnings before taxes. Now we have to have this pit stop along the way because we have to have earnings before taxes so that we can then calculate taxes on them. And so we'll typically always have this if we're a corporation, if we're a sole proprietorship, and you might see income statements that don't have the bottom line tax number because it's not the year end information, but corporations are typically required to calculate an estimate of the taxes. So you're always going to have this earnings before taxes and then the taxes. Now remember, taxes really muddy things up because the taxes are gonna go up as income goes up. So they kind of make the calculations a little bit messy. So when we do ratio calculations, taxes are always kind of a weird issue with the taxes. And when you're trying to measure performance and whatnot, the taxes can be a little bit confusing. Also, and that's going to be our next item, the taxes we'll calculate. We'll typically calculate the taxes based on the earnings before taxes, meaning we'll typically have some type of percentage that we'll calculate the taxes on. And when you have that percentage, you might be thinking, well, that's kind of weird because the tax return, if you were thinking about the tax return, you're not going to be basing the tax return on earnings before taxes. You're going to be basing it on taxable income, meaning taxes will have different kinds of things that may or may not be expensed. So will typically be a difference between book income and tax income, and you might have credits that might be involved in it. You might have different taxes that are income taxes, like federal income tax, state income tax. So how can you apply the tax rate to the book income in this way? Well, the answer to that is that corporations will typically be required to kind of estimate a rate based on, a projected rate that they believe they can apply to the book value. So when we use this tax rate, it's going to be a rate that we're assuming that the corporation came to that can be applied to basically the book income based on the estimate that they came about. We have an advanced accounting course if you want to think about how that estimate comes about, how they come about that estimate. But just realize that we're not just simplifying the process here. In that we're not saying that they're just going to apply a tax rate. They actually do that in practice. They apply a tax rate oftentimes to the actual operating income, but it's a tax rate that they estimated that they then can apply to the operating income. So then we'll have the taxes. The taxes will go up as the earnings go up. So as earnings go up, taxes go up because their silent partner is the federal and state government. So every time you earn more money, then they want more of it, or they expect more of it, or they're due more of it, however you want to see it. So therefore, taxes will be increasing as the earnings before taxes go up. That'll give us then the earnings after taxes. So we had earnings before taxes minus the taxes is the earnings after taxes. And that's going to be basically our bottom line number. You can think of that as kind of like the bottom line number on the income statement. Now, this was a long process to get there because we have a lot of subtotals. Note that you can get there in the same way. We could have shortened this down to what's called a single step income statement as opposed to this, which is a multiple step income statement. We'll typically just use this statement because for finance, we'll almost always use a multiple step income statement because we want the detail in order to do ratio analysis. But you could break this down to a much easier calculation, which would simply be revenue minus the cost of goods sold, minus the selling and admin, minus the depreciation expense, minus interest expense, minus the taxes, which would bring us down to the earnings after taxes, or basically net income. And we could then eliminate all the subtotals, which make this thing a whole lot longer along the way. But again, it just depends on how much detail you want. So typically in finance, we want the long, detailed statement because we want all those subtotals. Now, we could also have on the income statement basically a calculation of the earnings per share. So the earnings per share calculation could be tacked on to the bottom of the income statement, basically. So we're going to say we have the earnings after taxes. That's where we left off last time. Then we're going to take off the preferred stock dividends. Now, not all companies might not all have preferred stock dividends. They can be kind of confusing because remember, when you think of stock, you're thinking about the owners of the company. But you're like, when I think of stock, I'm thinking common stock, and that's right, you should. You're thinking common stock are the owners of the company. Common stock are the ones that are broken down into standardized chunks that represent ownership of the company, in that they have claim to the company, but they also have voting rights to the company. Those voting rights, the ability to vote for the board of directors, is really what makes the common stock what we consider to be the owners, because they have control in that way of decision making in some way. They get to vote, similar to us voting in elections, right? We get to vote for somebody. And if we only have one share, the vote doesn't feel like we got too much control there. But if you can vote, if you have a lot of shares, then you can vote, right? So that's going to be the preferred stock is preferred, but it's preferred because they get paid first, meaning if there are dividend distributions, usually the dividend distributions need to go to the preferred shareholders. So if there's a dividend that is declared, then the dividends can't go to the common shareholders, the owner, until you pay the commitment that was made to the preferred shareholders first. That's why they're preferred. However, that preference doesn't mean they're better. It just means it gets paid first. So it doesn't mean it's better necessarily, because the preferred shareholders don't have the equity interest, in that they don't have voting power, right? So preferred shareholders, you think of them as people that get paid first when there's a distribution of dividends. Because remember, when the company gives out dividend distributions, they have to give them to everybody. That's part of the thing. That's part of the thing about the standardization of the shares. So if the company says the owners are going to get money, we're going to pay out a distribution to the owners in the form of dividends, they can't just pay one owner. They can't pay one stockholder. They have to pay all the shareholders some fixed amount. That's what it means for the shares to be equal and the same. Before they pay all the money out to all the shareholders, though, they've made a commitment to the preferred stockholders that they get paid first, some kind of fixed amount, before the earnings go to the common stockholders. Therefore, we have to, if there are preferred stockholders, and they're not always preferred stockholders, they confuse things, we have to take the earnings after taxes, then subtract out the preferred stock dividends, which will give us the earnings available to the common stockholders. So we have the earnings, net income, how well we did over time, minus the income, minus the expenses. Then we're going to take out the commitment that we made to the preferred stockholders. That's how much earnings that we can now apply to the common stockholders, who we think of as the actual owners of the company. So then we're going to divide that by the shares outstanding. Shares outstanding represent the number of shares that are out there that represent ownership in the company. And that doesn't represent, the number of shares doesn't represent the number of owners, because an owner could own multiple shares. But the number of shares represents the units of owners, kind of like the number of dollars that are out in the currency that's out there, right? They represent the units of ownership that are out there. So then we're going to take I'm taking a calculator as if there were numbers here. We take the earnings available to the common shareholders divided by the shares outstanding, and that would give us our earnings per share. So that would be giving us the earnings per share. So really, you want to think of the income statement, basically bottom line being here at the earnings after taxes, which you can think about as basically net income, revenue minus expenses. And then you want to think about this as something that you can easily kind of tack on to the income statement, which would be the calculation of the earnings per share. Once you have the earnings, you can break it down to then how much of those earnings would be allocated out to the chunks of ownership, the units of ownership, the stocks that are out there.